If China owns 800 billion of US debt, which they do, then of course the United States, as the borrower, has to pay interest, which means that you and I and everybody else gets to pay taxes every year.
The global financial markets were rocked when news broke that China had liquidated its entire holdings of US Treasury securities. This unprecedented move sent immediate shockwaves through governments, financial institutions, and investors across the world. For decades, China had been one of the largest foreign holders of US government debt, providing critical support to the stability of American financial markets and, by extension, the global economic system. The sudden and complete sale of these assets upended a relationship that many had come to see as a permanent fixture of modern economics. Before we start, smash the like and subscribe buttons for more updates. The sale represented a stunning shift in China's strategy. Traditionally, Beijing had relied heavily on US Treasuries as a safe investment for its massive foreign currency reserves, a natural consequence of years of trade surpluses with the United States. Holding treasuries had not only provided China with a steady return, but it also tied its economic fate closely to America's financial well-being. The decision to sell all holdings, therefore, marked a decisive break from a decades-old policy, signaling a radical rethinking of China's role in the international economic order. Markets reacted with immediate volatility. Yields on US Treasuries, which move inversely to prices, spiked as the sudden flood of bonds overwhelmed demand. Investors scrambled to understand the implications of China's decision, selling off government bonds and triggering sharp declines in major stock indices. The US dollar, long considered the ultimate safe haven currency, weakened considerably against a basket of other major currencies. Confidence, always a fragile commodity in the financial world, took a significant hit as traders began to question whether other nations might follow China's example. The implications stretched far beyond the immediate turmoil in financial markets. China's decision represented a profound challenge to US economic hegemony. For years, the strength of the US dollar and the centrality of US financial markets had underpinned America's geopolitical power. By liquidating its holdings, China had signaled its willingness to disrupt this balance, introducing new uncertainty into an already complex and interconnected world. Some analysts argued that China's move was an inevitable outcome of a broader geopolitical strategy aimed at reducing its dependency on the United States. As tensions between Washington and Beijing had escalated in areas ranging from trade to technology to military posturing, the economic ties that once bound the two powers together had increasingly frayed. Selling off US Treasuries could be interpreted as China's attempt to insulate itself from future American economic coercion, especially in a world where financial sanctions were becoming a common tool of statecraft. Others saw it as a desperate gambit by Beijing to manage internal pressures. China's economy had been grappling with significant challenges, including a real estate crisis, slowing growth, and rising youth unemployment. Some speculated that the government needed to repatriate its assets to shore up domestic financial stability, providing liquidity to its struggling banks or funding critical economic initiatives at home. By converting foreign assets into usable cash, Beijing might have been prioritizing short-term survival over long-term strategic positioning. Whatever the motivation, the global ripple effects were profound. Central banks around the world faced immediate dilemmas. Many had long modeled their monetary policies around the assumption of stable US Treasury markets. The sudden disruption forced a rethinking of strategies from London to Tokyo. Some countries, wary of being caught off guard, began quietly reviewing their own exposure to US assets, wondering if the age of the dollar's uncontested dominance was coming to an end. The psychological impact of China's decision could not be overstated. Confidence in the stability of international financial arrangements is built as much on perception as on reality. The idea that one of the largest holders of US debt could, at any moment, decide to walk away fundamentally altered how governments and investors thought about risk. No longer could anyone take for granted the assumption that economic interdependence would deter radical moves. A new era of financial nationalism appeared to be dawning. Washington, for its part, found itself grappling with immediate and difficult questions. The US government depends heavily on borrowing to finance its activities, and the loss of a major buyer for its debt threatened to increase borrowing costs dramatically. Higher interest rates would ripple through the economy, raising costs for businesses and consumers alike, and potentially slowing economic growth. Policymakers faced a stark choice: find new buyers for U.S. debt, raise interest rates to attract capital, or reduce spending, each with its own set of economic and political challenges. In the broader geopolitical arena, China's move was a clear assertion of its willingness to wield economic power as a tool of influence. By destabilizing U.S. financial markets, even temporarily, Beijing demonstrated that it possessed levers of influence beyond military strength or technological prowess. Financial power, long considered America's unassailable advantage, was now evidently vulnerable to targeted strikes. Speculation abounded about where China would reinvest the proceeds from its treasury sales. Some suggested that Beijing might pivot toward gold, other major currencies, or sovereign bonds from friendly or non-aligned nations. Others posited that China could use the funds to support its Belt and Road Initiative, further embedding its influence across Asia, Africa, and Europe. Whatever the ultimate destination of the funds, the act of selling itself sent a powerful message. China no longer saw US Treasuries as the cornerstone of its financial strategy. Global investors found themselves facing a new and unfamiliar reality. Risk models, built on decades of assumptions about the stability and predictability of U.S. government debt markets, suddenly appeared outdated. Asset managers, pension funds, and sovereign wealth funds scrambled to reassess their strategies. Diversification, always a prudent principle, now seemed a matter of urgent necessity. The traditional notion of treasuries as risk-free assets had been irrevocably undermined. Meanwhile, smaller economies feared the collateral damage. Many emerging markets rely on stable U.S. interest rates to maintain their own economic health. A spike in U.S. yields could trigger capital flight from these nations, raising borrowing costs and exacerbating financial vulnerabilities. The risk of currency crises and debt defaults loomed larger, threatening to create new hotspots of instability around the world. At the same time, the development sent energy markets into a state of flux. Commodities priced in U.S. dollars, including oil and natural gas, saw volatile trading as the value of the dollar fluctuated wildly. Countries dependent on energy exports found themselves caught in the crosswinds of shifting currency valuations and uncertain demand. Multinational corporations, too, faced new complexities in managing their global operations, as exchange rate volatility introduced fresh layers of uncertainty into supply chains and profit margins. In political capitals around the world, leaders and advisors convened emergency meetings to understand the ramifications. Alliances were tested as governments weighed the risks and rewards of aligning more closely with either Washington or Beijing. Financial dependencies that had long been considered benign now appeared fraught with strategic peril. The financial world had been forcibly reminded that money, like power, is never neutral. Even inside China, the move carried significant risks. By selling such a vast amount of U.S. assets, Beijing risked eroding the value of its remaining dollar-denominated holdings. Critics inside and outside the country warned that destabilizing the global financial system could backfire, causing more harm to China's own economy than to that of the United States. Yet the boldness of the move suggested that China's leadership was prepared to accept significant short-term pain to achieve longer-term strategic objectives. The event also rekindled debates about the future of global reserve currencies. For decades, the US dollar had reigned supreme, supported by deep and liquid financial markets, strong property rights, and the sheer size of the American economy. But China's actions raised fundamental questions about whether the dollar's primacy could be sustained indefinitely. Alternatives, from the euro to an expanded use of the Chinese yuan in international transactions, began to be discussed with renewed seriousness. Technology, too, became part of the conversation. The rise of digital currencies, both private and sovereign, offered tantalizing possibilities for reducing dependency on traditional financial instruments like US Treasuries. Some speculated that China's move might accelerate efforts to create alternative payment systems and financial infrastructures that bypass the dollar entirely. In a world increasingly defined by rapid technological change, financial innovation could soon reshape the very foundations of international commerce. At a human level, The shockwaves reverberated through households and businesses far removed from the centers of power. Retirees watched their investment portfolios shrink. Small business owners faced higher borrowing costs. Homebuyers encountered steeper mortgage rates. The event underscored the deeply interconnected nature of the global economy, where decisions made in distant capitals could have immediate and profound effects on everyday lives. Academics and historians began drawing parallels with past episodes of financial upheaval, from the collapse of the Bretton Woods system in the 1970s to the 2008 global financial crisis. Yet there was a growing consensus that this event represented something fundamentally different: a conscious, strategic use of financial leverage as a geopolitical weapon, rather than the unintended consequence of economic mismanagement or speculative excess. The shock also prompted soul-searching within the United States. Some commentators argued that over-reliance on foreign financing had left America vulnerable, highlighting the need for renewed fiscal discipline and investment in domestic economic resilience. Others warned against overreacting, noting that the depth and sophistication of U.S. markets would ultimately allow the country to weather the storm. Still, there was no denying that the psychological damage had been done. Trust, once broken, is difficult to rebuild. Across the globe, new alliances and economic blocs began to emerge as countries sought to protect themselves from future financial shocks. Discussions about creating alternative reserve currencies, regional trade agreements, and new financial institutions gained momentum. A multipolar financial world, once a theoretical possibility, now seemed an increasingly likely reality. In many ways, the event marked the end of an era. The comfortable certainties that had underpinned the global economic order for so long were gone. In their place was a more fluid, uncertain landscape, where power was more diffuse, and stability could no longer be taken for granted. China's sale of its US Treasury holdings had triggered not just a financial shock, but a profound reordering of the global system. The world would move forward, as it always does, but it would do so in a fundamentally changed environment. Old assumptions would be questioned, new strategies devised, and the delicate dance of international finance would continue, albeit to a different tune. The reverberations of China's audacious move would echo for years to come, a testament to the extraordinary power of money in shaping the destiny of nations. The enormity of China's decision to divest its entire US Treasury holdings continued to reverberate across every sector of global finance, political discourse, and strategic planning. What had begun as a financial shock quickly morphed into a catalyst for a series of deep structural changes that would alter the course of international relations for generations to come. In the wake of the sell-off, new patterns of behavior emerged among nations, investors, corporations, and ordinary citizens alike, each adjusting to the profound uncertainty now baked into the system. One of the most immediate developments was the acceleration of efforts by multiple nations to establish bilateral and multilateral trade agreements that bypassed the use of the US dollar entirely. Where once dollar-denominated trade had been the default, now countries increasingly preferred to transact in their own currencies or through barter-style arrangements that minimized reliance on any single monetary system. This new wave of economic nationalism, driven partly by fear and partly by ambition, began to erode the traditional dominance of American financial institutions over global commerce. Major economies like India, Russia, Brazil, and South Africa expanded their existing frameworks for alternative payment systems. Efforts to strengthen and internationalize digital platforms for cross-border transactions gained traction, with blockchain technologies and central bank digital currencies, CBDCs stepping into the spotlight. China, already a pioneer in developing its digital yuan, found eager partners willing to explore new monetary infrastructures that circumvented Western-dominated frameworks like SWIFT. What had previously been theoretical discussions about de-dollarization now became urgent, actionable policy goals. Meanwhile, multinational corporations faced an entirely new risk calculus. Firms that had traditionally parked excess cash in treasuries or operated primarily within the U.S. financial system were compelled to diversify more aggressively. Treasury departments within Fortune 500 companies began reallocating reserves toward a broader basket of assets. Gold, high-quality corporate bonds from stable economies, and even direct investments into physical assets like real estate and infrastructure projects abroad. Corporate boards, wary of geopolitical exposure, started re-evaluating global supply chains, preferring jurisdictions less vulnerable to financial shocks tied to American markets. The banking sector, long accustomed to viewing US Treasuries as the ultimate form of safe collateral, had to adapt with breathtaking speed. Regulations built around the assumption of risk-free treatment for American government debt came under immediate scrutiny. Banks recalibrated their risk models and adjusted their balance sheets to accommodate higher capital charges associated with holding U.S. assets. Stress tests, internal audits, and emergency liquidity protocols were revamped to account for scenarios that only months prior would have been deemed inconceivable. In response to the tectonic shift, sovereign wealth funds also began charting a different course. Institutions like Norway's Government Pension Fund Global, Singapore's GIC, and various Middle Eastern funds undertook comprehensive reviews of their exposure to U.S. debt markets. Many moved aggressively into alternative assets, emerging market bonds, private equity, renewable energy projects, and technology startups. The diversification was not just geographical but strategic, seeking out investments that were less correlated to the fate of any single nation's financial system. Political reactions within the United States intensified as the economic consequences unfolded. Lawmakers from across the political spectrum demanded investigations into how such a vital dependency had been allowed to form and persist for so long. Debates raged about fiscal policy, with some calling for massive spending cuts to reduce federal deficits, while others advocated for sweeping tax reforms to rebalance the nation's finances. The political polarization that already gripped the U.S. deepened further, as different factions blamed each other for exposing the nation to foreign vulnerabilities. On the international stage, China's move emboldened other nations to reconsider their strategic options. Countries that had once quietly accepted American financial dominance began exploring ways to hedge against it. New financial alliances began to form. Regional financial safety nets were expanded, with ASEAN nations boosting their emergency reserve pools and Latin American economies strengthening inter-regional cooperation to manage liquidity crises. Africa, long marginalized in global finance discussions, saw renewed interest as a destination for diversified investment flows, positioning itself as a critical player in the emerging multipolar financial order. China itself began reshaping its international image following the move. Once viewed primarily as the world's factory, China now sought to project the persona of a sovereign, self-sufficient superpower capable of rewriting the rules of international finance. High-level diplomatic efforts were launched to reassure trade partners and stabilize relationships that could have been frayed by the boldness of the Treasury sell-off. Special economic partnerships were announced with countries eager to align themselves with the rising power, drawn by the promise of investment and a seat at the table of the new financial architecture. At the academic level, economists and policy analysts engaged in a flurry of research to understand the new dynamics. Traditional macroeconomic models, many of which were predicated on the idea of an immutable dollar-centric global order, underwent rapid revision. Universities and think tanks organized emergency symposia, and new schools of thought gained prominence, advocating for a more decentralized understanding of global capital flows. Disciplines like political economy and international finance experienced a renaissance as scholars sought to map the contours of this emerging world. The psychological impact on American society was significant. For decades, there had been an unshakable belief among many that the U.S. financial system was unassailable, its dominance assured by both history and sheer inertia. Now that belief was broken. Confidence in the infallibility of American institutions, from Wall Street banks to Washington's policymakers, declined. Public discourse began to reflect a deep unease about the country's position in the world. Conversations that once focused on domestic politics expanded to include discussions about global strategy, reserve currency status, and the importance of economic sovereignty. Technological innovators seized the moment to propose solutions for a more resilient financial future. Fintech startups offering decentralized finance DeFi platforms saw surges in investment as users looked for alternatives to traditional banking. Crowdfunding models for sovereign debt issuance gained attention, where retail investors could directly fund government projects without intermediaries, reducing dependency on large institutional buyers like China had once been. Visionaries in Silicon Valley and beyond spoke of an era of financial democratization where no single nation could hold the world hostage through strategic asset manipulation. Insurance and risk management industries also underwent transformation. Political risk insurance, once a niche product primarily for corporations operating in unstable regions, became mainstream even within traditionally safe markets like the US and Europe. Actuaries incorporated sovereign asset sell-off scenarios into their models, offering new products to hedge against such geopolitical events. Institutional investors, from pension funds to university endowments, began demanding more sophisticated protection strategies for their portfolios. Beyond financial markets, cultural shifts took root. Literature, film, and journalism reflected the changing global mood. Novels speculated on dystopian futures where financial wars replaced conventional ones. Documentaries examined the fragility of the global order with newfound urgency. In every creative medium, the theme was clear. The old world was ending, and a more volatile, unpredictable one was emerging. Youth movements in particular embraced the spirit of change. Young activists, already skeptical of traditional power structures, found new energy in advocating for financial decentralization and economic justice. Campaigns to audit central banks, promote open-source financial platforms, and push for greater transparency in international financial institutions gained traction. The sell-off had not just rattled markets, it had awakened a generation to the profound connections between money, power, and freedom. Meanwhile, Washington's allies around the world found themselves in a precarious position. Nations traditionally aligned with US interests, from European powers to Pacific partners, had to navigate between loyalty to old alliances and the pragmatic need to protect their own financial futures. Some doubled down on their commitment to the existing system, launching joint initiatives to stabilize treasury markets and backstop the dollar. Others, however, hedged their bets, quietly opening channels of communication with Beijing and exploring options that might have been unthinkable only months earlier. Think tanks and strategic advisory firms sprang into action, offering seminars, white papers, and consultation services for governments and corporations desperate to adapt. Risk mitigation strategies, geopolitical forecasting, and scenario planning became booming industries. A new class of experts emerged, those who could blend financial acumen with geopolitical insight, capable of navigating a world where economic moves were as potent as military ones. As the dust settled, a new global reality crystallized. No single country, not even China or the United States, could dictate terms unilaterally anymore. Multipolarity wasn't just a theory discussed in foreign policy circles. It was the lived experience of every trade negotiation, every cross-border investment, every strategic alliance. The power of money, once concentrated in a few hands, had begun to redistribute, creating both opportunities and dangers in equal measure. Financial hubs around the world evolved in response to the new environment. Cities like Singapore, Zurich, and Dubai positioned themselves as neutral, stable alternatives for capital, looking to escape the volatility of New York and Beijing. They marketed themselves as safe havens for multinational corporations, family offices, and sovereign investors seeking predictability amid uncertainty. Competition between financial centers intensified, reshaping the geography of global finance in ways not seen since the post-war era. The energy sector also adapted to the financial realignment. With dollar volatility disrupting oil markets, producers and consumers explored pricing energy contracts in alternative currencies or baskets of currencies. Discussions about creating a new global energy pricing mechanism gained momentum, potentially undermining one of the last major pillars of dollar supremacy. Energy geopolitics, already a complex field, became even more intricate as currency considerations added new layers of strategy and risk. Over time, a broader philosophical shift took hold. The idea that stability was the natural state of international relations gave way to a more dynamic, even Darwinian worldview. Nations, corporations, and individuals realized that adaptability, resilience, and strategic diversification were no longer luxuries but necessities for survival. Those who clung to old certainties found themselves increasingly marginalized, while those who embraced the new reality thrived. Thus, China's liquidation of its US Treasury holdings proved to be not just a financial event, but a historic inflection point. It exposed the fragility beneath the surface of global finance, shattered illusions of permanent American dominance, and unleashed a cascade of changes that redefined how power, money, and influence operated on the world stage. A new chapter had begun, one filled with complexity, competition, and the exhilarating, sometimes terrifying possibilities of a truly multipolar world. The magnitude of China's complete divestment from US Treasuries continued to unfold, setting into motion a series of deeper, less visible but highly transformative consequences that touched every sector of the global order. After the immediate market reactions had stabilized somewhat, the subtler, longer-term structural shifts became more apparent. It was no longer merely a question of who would buy US debt or how governments would manage currency exposure. It was a wholesale reimagining of global economic frameworks, value systems, and even future development trajectories. Among the earliest and most profound developments was the renewed debate around monetary sovereignty. In many corners of the world, policymakers began to reassess the very structure of their national economies. Nations long dependent on foreign capital, particularly developing economies, recognized their vulnerability to external shocks in a globalized system underpinned by a single dominant financial player. As a result, there was a broad push for enhancing internal capital markets, encouraging domestic savings, and fostering homegrown investment ecosystems to reduce exposure to foreign bond markets. This effort gave birth to a new era of financial regionalism. Countries that once relied heavily on Western financial institutions started to prioritize local and regional financial collaborations. Pan-African banking systems, Southeast Asian investment funds, and Latin American sovereign lending pools began to take shape, creating alternative funding channels outside the traditional global financial system. These institutions, designed with built-in resilience against external shocks, served as a hedge against future systemic upheavals. Furthermore, the event fundamentally reshaped how risk was perceived and priced globally. No longer was risk merely evaluated through the lens of economic indicators like GDP growth, inflation rates, or interest rates. Geopolitical alignment, political stability, and strategic autonomy became critical elements of creditworthiness. Investors scrutinized countries not just for their fiscal management, but for their ability to shield themselves from international financial coercion. Nations that could demonstrate independence from major power blocks or at least credible hedging strategies saw improved access to capital at lower rates. Simultaneously, China's withdrawal injected a new dynamism into the debates about alternative asset classes. With the risk-free status of treasuries now in question, global capital flows shifted towards tangible assets with intrinsic value. Infrastructure investments, particularly in renewable energy, transportation, and water systems, attracted unprecedented levels of interest. Agricultural land, mineral rights, and intellectual property portfolios became prized stores of wealth, offering stability in an increasingly volatile financial environment. Cryptocurrencies and decentralized financial systems, already gaining traction before the sell-off, surged into mainstream acceptance at an accelerated pace. Governments that had previously treated digital assets with suspicion found themselves re-evaluating. Some embraced these technologies, seeing an opportunity to create more resilient, autonomous financial systems. Central bank digital currencies, CBDCs, proliferated at breakneck speed, not only in China but across Europe, Latin America, Africa, and parts of Asia. These state-backed digital currencies promised faster transactions, lower costs, and reduced exposure to traditional geopolitical financial risks. Alongside these changes, the global architecture of financial governance itself started to fracture. Institutions like the International Monetary Fund and the World Bank, long dominated by Western interests, faced growing calls for reform from emerging economies. New multilateral development banks, often led by China, India, or coalitions of non-Western nations, began to rise in prominence. These new institutions promised to offer funding without the political strings often attached by their Western counterparts, further diminishing the influence of traditional financial power centers. Amid these macro-level changes, individual behavior also evolved dramatically. The educational sector responded to the seismic shifts as well. Business schools redesigned their curricula, embedding courses on geopolitical risk, decentralized finance, and alternative economic models into their core offerings. Economic theory itself began to adapt, moving away from the once dominant neoliberal frameworks toward a more pluralistic, interdisciplinary understanding of markets, state power, and international relations. If you liked this video, please give it a like and subscribe to our channel. Also, leave your comments below and tell us, what are your thoughts on China selling all US Treasuries? Big shock or bluff? We want to hear from you. Thank you for watching and see you next time.